Hello everyone, welcome to Quick Start Lab. Andy Tanner here. I'm joined by Corey Halliday. How are you, Corey?
I'm doing great. Excited to be here.
Let's see, this is Quick Start Lab 3, I believe, isn't it?
This is number 3, exactly right.
2023. Exciting stuff. And we welcome everyone. Let me make sure I bring up my question box so I can see that everybody can hear me okay. Can everybody hear me all right? Am I audible to all? Excellent, fantastic. And just welcome everybody here. Hey, Sean Stone from Texas. Hope we see you in Houston, Sean. Let's see, we got Tampa in the house, we got Toronto in the house, we got Seattle, we got Palm Desert, California in the house, Canada. Fantastic stuff. Very enthusiastic people. Isn't it nice to, like, we work very hard to repel
Yeah.
people that we wouldn't want to teach or work with. And you guys have just done a great job. Let's hop right in. We have a lot to cover. We're going to do this Quick Start Lab in a couple of halves. I'm going to start off with some conceptual things, some big picture things. Then Corey's going to drill down and check on our trades, and we're going to add another one, of course. But let's get our disclaimer, very important, particularly in Quick Start Labs. This is risky stuff. In fact, some of the things we're doing, I would consider on the upper end of risk. They're not insanely risk, but that you could mess up to where it looked like you have taken an insane risk. And just understand that we're here to educate and to take it slow. Excuse me. To that end, I'm going to talk what I would deem, and this is just my opinion, basic, maybe towards a more advanced. I don't even know if I want to use the word advanced because that's a relative word, but we'll just maybe say, intermediate to advanced. Is how many of you have taken the 4 pillars of investing class at least? I mean, most of you probably have if you're listening here. So in that class, we learned how to buy stock, which is long stock. And that's a wonderful thing because often you can get the growth of the stock long term, which is less impressive to me because how do you know when to sell it? More importantly, the dividend, right? So you're going to get the dividend, and that's the cash flow. That's the most important. We also show you how to short stock, and short positions are essential to understand, not so much for stock, but to make money when something loses value. So you're happy when things lose value. And I would submit that understanding a short position is to be a leveraged real estate investor. I know of no trade to which I would have more confidence over a 30-year period than the loss of value in the US dollar. Intermittently, we may have some spikes and valleys in it, but over a 30-year period, considering, save a change in policy, barring a change in how our money system works, I know of no trade of which I would have more confidence. And so that short position happens in 4 stages. We borrow, we trade back, and we return what we borrow. And in a financial statement, it's all 4 stages: borrow, exchange, trade back, and return, in a financial statement. So to understand the short position is to more fully and more comprehensively understand the cash flow pattern of leveraged real estate by a debt. Very important to understand it, not just for stocks, but as a concept in general. Number 3 is we have a long option. We could call it a long call. Number 4, we could say we have a long put. Number 5, we could have a covered call, which combines long stock. Whoops, long stock plus a short call. So that's our first complex trade where we have more than one thing going on. We're marrying two things, which could lead to a married put. And we could also, in isolation, have what we call a cash secure put. Would be really nice. I think that might be a sufficient thing. Corey, do you want to comment on why a married put is called a married put?
Yeah, so in marriage, two people are linked together, right? And so a married put is different than a long put. A long put would just be speculating on downside. I'd go out and buy a put is what that means. And I just think the stock's going to go down and I'm just speculating on that move and hoping to profit. A married put is different because I own the stock and then I marry it with buying a put. So now the two work together, and because of that, I'm bullish. The net trade is bullish. The long stock is the most important aspect of the trade. I'm just buying a put in case I'm wrong and in case the stock goes down. That put can decrease the damage. It can be protective in nature so that as the stock loses, the put goes up and it creates kind of, to use the marriage example, my wife and I are very different people. She's artistic. I'm much more of like a numbers and that type of person. And so we work well together because her strengths are my weaknesses and that sort of thing. And that's kind of what the long stock and the married put. The strength of the long stock is, well, if we go up, the long stock's going to make money and the short put or the long put, the protective put can only lose what I paid for it. If we go down, at least where the long stock is losing, the put is helping make up some of that. So they're a tandem, they're working together.
And by the way, speaking of you and Jackie, you definitely outkicked your coverage right there. Okay.
For sure. That's why we don't teach her about stop losses. Okay, she just needs to not be too aware of some of those things. Stay in the artsy stuff, and she does amazing stuff with like art and different things where she's the director of the play at the school and that sort of thing, and that's her niche, and certainly not anywhere where I would have any strength. So it works well.
With this, your maximum risk is what you paid for the stock. This has infinite risk, so you want to be careful with that. We do that with exit strategy. This, your maximum risk is your premium paid. This, the maximum risk is your premium paid. So it's, unless you put all your money in that stuff in one place, it's tough to lose it all. But if you buy put all your money in a long call and it doesn't go up, you could lose, potentially 100% of that premium put in. Covered call actually has less reward than long stock. So I guess that's less than. And this is actually less risky than long stock. And this is actually less risky than long stock. But in all three of these, you have less reward. You're certainly putting a cap on your reward with this one. And you're certainly putting a cap on your reward with this one. And you're certainly diminishing your reward with the cost of the long put. So, this one's, insanely risky, very, very risky. But other than that, these are all things you could do in an IRA account if you live in the United States. They're all things you could do in a retirement account if you live in the United States. If you have a custodial account with children, like I do, my sons do all of these except the short position. They wouldn't allow that in the IRA or the custodial account. So barring number two, you could do all of those in a fairly beginner level account. And what's good about these is I would just look at rate of return. And basically I would say, how much money do I have, value initial, what I like to have, the final, what time would I like to have that in, and what percentage growth would I have to have? And then once I achieve that, once I have that final value, what percent of rate of return would I need to retire and be out of the rat race and achieve my goals? And that's it. So all of those things can be done for many people with just that stuff, just long stock, with that list of strategies. Does that make sense, everybody? So you would want to look at your goals and say, okay, this is what I think I can do with this list of strategies. I think simply by adding, a covered calls and that option income, cash secured puts and that option income to your dividend income would be a fabulous accelerator with, if it's done right and intelligently with education. Okay, so why is that? Okay, so why move into advanced? Well, if we find that we fall short of these percentages that we want, we'd have to increase risk to increase reward, which means we'd have to increase our knowledge of risk management. And we would get into advanced trades where we might start with a naked call. And this has infinite risk. I mean, infinite risk. And I do these a lot. I have them as I speak because I feel very confident in my ability to get them covered or manage that risk. And I think I have a pretty good understanding of the amount of capital I need to be able to deploy to do that, the amount of vigilance that makes sense if you're going to have these, if you're going to be married to these. But we also have other combinations. For example, we had, you can do a long call and a short call. And we added those together, and depending on which ones has the higher premium, it could be a credit spread and debit spreads. We can have a long put and a short put. And depending on, the short, if the short premium is larger than the long premium, we have a credit spread.
Yeah, and those are
true. We have a debit spread. Go ahead, Corey.
a debit, yeah, and those are what we've already introduced is the credit side of both of those. Because remember back from your notes and what we've worked through, the short option we sold brought in more premium than the long option cost. So we collected a net credit, and we started with the bull put credit spread, the name kind of suggesting, okay, we have a bullish outlook. We can use the puts. That's a point of confusion for some people. They didn't realize that you can actually use the puts to express a bullish viewpoint. They usually think of puts as being bearish, and that's just not the case. That calls and puts are neither bullish nor bearish. It's what you do with them that dictates your outlook.
Long or short. Exactly.
Yep. And so we collected a credit, and then we later did the same thing on the call side in Oxy in the next class. So we did examples of these more advanced strategies.
We can have long stock and short stock, and we can have, short, and here's the other thing, we can have short-term options plus a long-term option for what we call a calendar spread in terms of time, term. And as you begin to combine these, like a 4-digit PIN, there's only 4 numbers in a 4-digit PIN, but there's many combinations of those, right? Many thousands of combinations in a 4-digit PIN people would have to guess. And so you get into more advanced things that require a little bit more knowledge. Now, I'm going to introduce something called Greeks. And this is 4 pillars. And I feel very good that a person could do this without an understanding of Greeks. In other words, the reason I would be okay with a cash secured put without understanding Greeks is all that is about stock ownership. I want to own the stock. I consider it covered and my intent with a cash secured put is, my hope is actually to keep that promise I've made, to say, hey, I'm going to promise to buy this stock at a lower price, and I'm going to be paid handsomely for it, whether I own it or not. And so if I work out the numbers here, where it works with rate of return, what do I care what the hell the delta is, right? I'm just looking for a fundamental price. This is more fundamentals. This is more trading fundamentals. I'm just looking for a fundamental price at which I would be willing to buy the stock, and simply collecting money based on that value. So my strike price would be based on a valuation metric. Does that make sense? In other words, the stock got cheap enough that these numbers work for me now, that this dividend makes sense, that these covered calls make sense. I like that idea, right? Same up here is I simply could say, hey, maybe a little bit of delta here, possibly, maybe a little bit. But the Greeks down here, it'd be nice, maybe. I mean, it wouldn't hurt you to know them over here. It's a must on this side. It's a must. So over here, we have what we call our ultimate options course. And you don't need to take that right now. You can work on this side as long as two things happen, as long as your rate of return is fitting with what you choose, and as long as you're moving forward and progressing at an education rate you like. Some people find that the acceleration of the stuff, we showed last time, I think on the first time I showed a financial statement with just the dividend. Then I showed a financial statement with the dividend plus a call that was sold. And then we showed a financial statement with the credit spread. And then we showed a financial statement with the iron condor. I think it was something like 1%, 11%, I don't know, like 100+ % annualized, and like 300% annualized. But the risk went up drastically with this stuff. Does that make sense, everybody? And so Greeks are a must. And so I'm going to introduce you to Greeks and why an understanding of Greeks over here, an ultimate option type of stuff, opens the door to decision making that is much more astute. When we deal with an option, we start to juggle three things. We have a ball, we have a guy here, and he's trying to juggle. Well, let's do it right. Let's actually make him juggle. I don't know if my artistic skills can make this happen here, but he's actually going to juggle three balls. The first ball he's going to juggle is called theta. And he's got to keep track of that. The second ball he's going to juggle is called delta. And he's going to have to keep track of that. And the third ball he's going to juggle is called vega. And the reason these are so important is these are the three things that can change the premium of an option, okay? So I'm not going to give you formal definitions, because what I found, having taught this for 20 years, is when you give a formal definition, it feels very textbook-like, it feels very memorization-like, and it doesn't have real meaning behind just the regurgitation of the memory. So I'm not going to give you the formal definition. I'm just going to say that delta changes the premium based on changes, hence the word delta, right? Changes in the stock price, okay? So obviously, if the stock price changes, the option price will change. And if you've been through the four pillars, you understand this to a great degree. In the four pillars, we've already had a discussion of intrinsic value. And if an option, if I have the right to buy a stock, let's say I have a call option, says I can buy the stock at $100, and the stock goes from 105 to 110, I've had a tremendous increase of intrinsic value, because now it's trading at 110, but I have the right to buy it at 100. By locking in that price, with every dollar it climbs, the more valuable that option becomes. So type in a yes if you get this so far, okay? Type in a yes. This is awesome. Sean Stone is hilarious. He's like, have Corey's wife do the artwork. She really is an artist. She really is awesome. You should see, she did you, all you guys in like Marvel Heroes one, uh, Halloween. And she went as, who's the one, the Margot Robbie?
Yeah.
What the
So
heck's that called? What
I
is
can't,
that
I
character? It's a
can't
Marvel
remember what it's
comic. She's
called.
like got a baseball bat and stuff. Who knows who I'm talking about? What's the name of that Marvel comic? It's not like the Joker. Harley Quinn. Thank you, Matt.
Yeah,
Harley
Harley
Quinn.
Quinn. Yep.
Man, she looks better than Margot Robbie as Harley Quinn. Let me tell you. Margot Robbie would be embarrassed to show her face. She did a great job. So this right here, changing the stock price changes this. Okay, look. This is the change in time left before expiration. Okay, so we'll just say days left. And this is nice because it only moves one way. So that one's the most predictable of the three. I mean, Monday turns into Tuesday, you're going to lose a day. There's going to be a change in the number of days left in our trade every day. So when we started this trade, this trade on Oxy, we had a certain amount of time. Now we have 2 weeks less or a week less or whatever it is. And this is very important, is this is a change in implied volatility. And I don't know how to spell volatile. That's probably wrong. Is that right or wrong? Volatility?
That looks right to me.
I'm sounding it out. That's not it's right phonetically.
Your last I kind of looks like an F, but it's an I. I know.
Volatility. That's Tanner Ease. Okay, that's how I write. That's called freedom of speech. If anyone tells you spell things wrong or make the letters wrong, say, hey, you're trampling on my constitutional right to free expression. All right, so Vega, Delta, Theta, and we're juggling all these three balls because at any given day, this could go up, but this could go down, and this could go up, or this could go down, and this could go up, and that could go down. So this one's always down, but we could have any combination of those 5 factors change the premium, and so we want to know what those are. We want to know how, and all these things do is just tell us, it gives us a vision of how these factors, right? It helps us predict a little bit about how these factors change the premium, right? Change or could change or would change the premium. So we'll get into more of this next time. I'm going to show you the spreadsheet I use to get a grasp on this. But what that leads is also criteria. And we start to get a criteria of what deltas we like, what thetas we like, and what vegas we like. And it helps us find a comfort level in the trade. It helps us prepare for what type of risks could be involved. Now, the other reason this is so important. Oh, go ahead, Corey.
Well, I was just going to add that these are called derivatives, and that's because an option's value is derived from the stock moving, right? And the stock changing and the opinions on the stock changing and so forth. So if you think about an option is simply a derivative of the stock. So as the stock moves up, that will do something to every option out there, puts and calls. If the stock moves down, that will change the puts and calls in a certain way. That's delta, change in the stock price. Well, what if the perception of the stock has changed? What if all of a sudden there's some reason that stock is considered more risky than it was the day before? Well, that's a vega. That's a change to the implied volatility. Maybe Elon Musk is stepping down as the CEO of Tesla. Well, that changes the volatility expectations, right? And so the option premiums will move based on that change in expected volatility. And then, of course, options have erosion. There's an expiration date. So theta represents how that option is decaying in value day after day as we get to expiration. So as you kind of think of these, yeah, we're juggling these balls, but each one of them is just a certain factor that's in play in that option. And they're derivatives. It's because of the stock, it's because of the factors of the stock that changes these option values. And that's, as you start to kind of understand that, it will make more and more sense how each one of these works.
Ryan mentions that, Delta has a lot to do with network. That's true, because it's about price. Theta has a lot to do with cash flow. So if we're going to look at a house as an asset with our little cash flow jack in the box, you'd have the price, which is delta, right? But you'd also have the renter that pays rent, and he maybe pays that every 30 days. That is theta. Or, I think they make a thing like that. I don't know if that's an omega, but I think the theta, they do it like this. And so, and maybe the vega has to do with your insurance movement, right? Or, whether you live in an earthquake zone or not, or whether your, prices are volatile and really rising. So the reason that's important is very, very simple, is that when I drew that, basic side, when I drew that basic side, I'll show you why this is such a critical thing. I drew that basic side and I drew the advanced side. The basic side didn't need that stuff, and that was 4 pillars, and this is what we call ultimate options, and what we call the playbook. Those 2 classes, they help dissect the risk management. And what you're going to find with a lot of these credit trades is they're high risk, high reward, or moderate reward. Look, high reward, high probability trades, often. And we want to have all of those 3 elements as well. So once you get into advanced options, I got to know deltas, vegas, and thetas. And there's something called rho that has to do with interest rate, but that's more important now than it used to be when interest rates were 0. So rho may even be a 4th ball to start juggling. And then we're juggling risk, reward, and probability. And it is the trader that understands this and creates a regimen. And the most important part of this, of knowing all this, is that it assists greatly in the risk management, because that's where your money's going to be made. Your money is not going to be made, well, I shouldn't say this. That's where success will be had. That's a better way to say it. Your success is not had in your ability to write a credit spread. Your success is going to be had when it goes bad. Your success will not be had when the iron condor goes correctly. Your success will be had when you learn to manage the risk. And part of learning that is understanding that balance of delta. If you do not understand and have a grasp of option Greeks, risk, rewards, and probabilities, then stay in the 4 pillars for a while. Stay there and just work with that. If you find that those returns are not getting to your goals, and you say, no, I do want to learn to take on more risk, we begin with the Greeks. So with that, I think I'll turn it to Corey with that introduction on Greeks, okay? I appreciate, Janae says, I don't care if you can't spell. It's not a spelling, it's the context that matters. Thank you, Janae. Appreciate it. I got one person who understands me. And so, Corey, with that, I'll turn the time over to you.
Awesome.
I'm gonna make you the presenter. Maybe you can go through, and I'd like to stay high level without we don't want to get bogged down in definitions or actual metrics at this point. I want to keep it as simple as we can.
Yeah,
so I'll
for
go
sure.
ahead and make you the presenter, and I'll let you, I'll mute up here and listen and learn.
Yeah, so here's kind of, let's separate these a bit, and here's kind of a review of a little bit of what we've talked about to this point, right? We started off with an example of you could buy a stock and generate some dividends, and that's about 52 cents of income per share per year. You could buy some stock and get dividends and maybe sell some covered calls, and we showed an example of just a 1-month premium, and you could do that potentially 10, 12 more times throughout the year and really increase that cash flow. Or we introduced a couple of more advanced approaches, right? We started in the first session with the bull put credit, and then in the second session, we added the bear call credit. And so both of them were credit spreads. What does that mean? It means premium coming in. And Andy, you might not have hit the mute button quite right, but or somebody else jumped on, but either way, no worries. So we've got the bull put and the bear call. Yep, I can hear you.
Me?
Yeah.
Oh, I thought I had my mute button on.
No worries.
Okay, well, I'm eating a piece of chicken too, so hang on.
We can hear some noise. No worries.
Hang on, let me get my mute right.
Now you see behind the scenes. See, while Andy's talking, I'll be enjoying my chicken when I'm
You know what
talking.
sucks is, I'll tell you what really sucks about this chicken is, I'm back on my health kick. This chicken's freaking dry, dude. I need to put an onion on it or something, man. It's cold. It's out of the fridge. It's left over from yesterday. It's dry. All right, that. Hang on, I got to switch to now. Watch my sound get better. Watch this. See that? Did my sound just get better?
It did get better. What happened there?
Well, I had it on my webcam mic, and now I have it on my podcasting mic, and that's the one that muted to everyone's chagrin. While I chomp.
That's life changing.
There you have it. All right.
Awesome.
I'm mute now and choke down.
No worries. No worries. So here's the bull put credit, right? We sell the 55, we bought the 50, and we brought in money. Now, when we introduced this, we were trying for a 70-cent credit, but I'll show you the stock kind of gapped up, so we collected less. Last time we talked about the bear call credit, and we were going to sell the 70 and buy the 75 as like our reinsurance. Just a quick review. We were trying for around a 70-cent credit, and the market gapped up, and so we got more credit on that one. So they averaged out. We lost about 7 cents credit on the first one, but we gained 7 cents back on that one. So lo and behold, we collected 63 and 77. We've got an iron condor for a total of $1.40 at this point. So pretty good stuff here in terms of the risk reward probability. There's a decent chance we're going to have to hedge this and protect it because we went pretty aggressive. I mean, this is a big size credit. We'll talk about that more. But if you kind of look at the breakdown here, we had a $5 spread on this side, and we have a $5 spread on this side. So you can see that basically we have a trade that has $5 of risk, but remember, it can't be both places at once. It can't be below 75 and also above 75 at expiration. So you only take one side of the risk. Our risk is $5 minus the 140 credit, so our risk is 360. That's the most we can lose. Our reward in this case is 140. So our reward to risk ratio, of course, our risk is higher than our reward, but we've got probability on our side. In fact, our risk is about 2.5 times our reward. And it wouldn't be uncommon for it to be more than that, to have 5 times the risk of the reward and so forth, as a trade-off. There's a little bit of a teeter-totter effect. If you want better probability, if you want a really good high probability, then what's the trade-off? You get a worse looking risk to reward. If we want a lower probability, if we're willing to accept that, then we would have an excellent looking risk to reward, right? In this case, if we had a low probability trade, our reward might be 2 or 3 times our risk or what have you, right? So there's a little teeter-totter effect. We brought in more credit, so we sacrificed some probability. We took our probability down here, but we actually improved the risk to reward on this side, right? By bringing in more credit, it took our risk down and our reward up. So we sacrificed probability to get a better risk to reward. That teeter-totter, we have a teeter-totter effect that's not quite as steep, not as high a probability. So that's kind of one way to think about it in terms of risk reward probability. Now, let's come over and do our first review on Thinkorswim, and then I was going to show how to do these same things over on the Interactive Brokers platform, which we had a request for. And like we always say about the trading platform, usually we know it's someone that's new to trading, that's really concerned about their platform, because
Interject right there, Corey.
yes, please.
It's a lot like deciding, what car to drive. Certainly you can drive around in a Mercedes and you can drive around a Volkswagen, but essentially both of them will get you to your destination because there's speed limits anyway. And so while one might have an engine and really go nuts, there's speed limits on the road. And at the end of the day, you get where you want to go. If Thinkorswim or E-Trade or TD Ameritrade, any one of the, Interactive Brokers, if any went out of business, it would not affect Corey's intelligence, discipline, education. In other words, the things that really matter. Does it matter whether you use, Berkshire Hathaway Realty, what are the other ones? I can't remember. Remax Realty, whatever. A realtor is simply going to sell your home for a fee. That's it. They're called a real estate broker. So choosing a broker is about the same as choosing a realtor. It's not going to make or break whether you got a great deal. It's really the offer on your home. It's the negotiation in buying the home or selling the home. It's your efficiencies in fixing it up if you tend to flip, or your management if you tend to rent. And so just please don't get too overly concerned, because the same information is going to be available. And as far as risk graphs go, certainly Thinkorswim, I think they have some of the nicer risk graphs to look at. But Interactive Brokers has a version of them too. And here's the thing, in Ultimate, this is what's crazy. And I hate mentioning this because it seems like people couldn't grasp this. It seems like beyond their grasp, but I'll tell you it's not. Remember when some of you drove a stick or learned to drive for the first time, you have your kids and it's really scary. Pretty soon it's just automatic. Well, risk graphs are going to be the same thing. One of the things we do in Ultimate Options is we do not use software at all for risk graphs. We draw them all by hand. And the reason we draw them all by hand, well, it's kind of like you could use a calculator to do your times tables. But 6 times 6 is 36. And even a guy like me can remember 4 times 4 is 16, right? And 8 times 8 is 68. So is that right? 64, whatever the hell it is, so 8 times 8 is 64. So remembering your times tables can be done in your head, and so can the risk graph. So let me just throw this out here and see if how many would like to get to the point where you could see the risk graph in your head without even needing one? Who would like to be able to see that risk graph in their mind's eye? Because eventually that's where you're going to be. And we just accelerate that process in our advanced courses for that reason, because it takes about a year to get through Ultimate Options if you take a class a week. And my son did it faster than that. He took one about every 5 days or 4 days and got through it quicker. But it was invaluable to him to get out a paper and pencil and to build the trade and then draw the risk graph without software. And I just started him that way. So just as you might have learned your times tables in your head and then had the calculator introduced, don't worry about software. So with that, I'll shut up, Corey, but I just want to support and echo what you said, is that, give me any brokerage, I don't care. It's my trading skills that will help me or hurt me, not my brokerage so much.
Indeed. And we actually love to teach to do these on paper, because if you plug it into your brokerage, okay, great, you can see the numbers right off the bat, but it actually doesn't have as much meaning to you as it will when you actually build it yourself. When you draw them out by hand, you have to think about how to calculate your break even. You have to think about how to get to your max reward and to your max risk. And you have to think it through in a different way that makes it much more powerful in understanding the strategy. And so that's why we purposefully did that in Ultimate Options. Not only does it make who your broker is unimportant because you can do these by hand, you'll get to the point where you see them in your mind. When I build this iron condor, I can see it in my mind. Yeah.
Yeah, I just pull a sheet of paper off and have them watch you do it so they can say, oh, that's really not that complicated.
Yeah.
Draw just pick one, like go back to that. You have all those trades typed out.
Yeah.
Just go back to that information and just show them because it's
and just show. Yeah, absolutely. So let me just show kind of what.
I should ask if they want it first. You gotta see them do it. Here we go. Well, they're gonna do it.
Well, let's do it whether they want it or not. But here we'll just draw these 3 risk graphs really quick. And I'm not gonna spend a lot of time in worrying whether or not you understand everything I'm showing you. I'll just show you, we'll draw these 3, okay, risk graphs really quick. And here's basically a risk graph. You have your profit up here and your loss down here, right? It would have your gains and your losses, and same thing here, profit and losses, profit and losses. So watch this. If we buy the stock at 61.55, that's our break even. Everything above that is max gain. Everything below that is max loss. And if you would see numbers here that would say, well, I'm down $100, or I'm up $100, or I'm up 200, and it would just go like that. And because we bought at 61.55, where would you be up 100? At 62.55. So here would be 61.55. Here would be 62.55, and so on. And then where would we lose $100? Well, if it went down $1 a share, so 60.55 is where we'd be down $100. And it literally just goes on and on like that. And you say, okay, now I understand a long stock risk graph. Well, here's a little different one. We buy the stock at 61.55. We're going to ignore the dividends. We're going to bring in 75 cents in covered call income. 61.55 minus 75 cents is our cost basis. The moment we do this covered call, we paid 60.80 for the trade.
Reduced our risk.
Reduced our risk, reduced our cost basis. So see how this one has a break even. That's what the dotted line is the break even is 61.55. Here we'll have a break even of 60.80. So watch this. Our break even is 60.80 instead of 61.55. Let me kind of highlight that. Break even
to the left. Yep.
Yep. And so watch what happens here. We sold the covered call strike price at 70. So let's draw some prices out here. Here's 65, here's 70 per share. This would be 55, the stock going down quite a lot and so forth. 70 would be our max gain. And our max gain is strike price minus cost basis. So $9.20 is the difference between where our gains are capped and our total cost basis. $9.20. So $9.20.
Well, the reason that's the most we can make is we've agreed to sell it at 70. So anything above 70, we don't get. Yep. So instead of having a graph on the left where we have arrows going forever, we cap out at 70 because we have to sell at that price of 70, and then right down to our break even right there. Beautiful.
And then this keeps falling this way because we still have the risk to the downside. It's reduced by the income. So our break even was reduced by 75 cents in the covered call versus just owning the stock, but we still have unlimited downside down to 0 in both of these situations. Here we have uncapped gains. Here we capped our gains, but way up there at $70. Now notice, if the stock goes to 75, we still have our gains capped. We don't make any more up there.
The reason I'll often do the one in the middle is say, well, Andy, why would you ever want to cap your gain? Why would you ever want to cap your gain? I mean, this one has unlimited, infinite upside, and you only got, $9.20 here. Why would you ever want to cap your gain? I'll tell you why. The chances of it getting that far in that short a time is relatively modest. It's relatively slow. In other words, I'm not really worried about capping my gain because I think the chance of it going to infinity is, about zero. I think the chances of it going to, 100 are very minuscule. I think the chance of it going to 90 or even smaller, chance of it going to 80 and maybe a little bit bigger, chances of going to 70 maybe a little bit better, but not to the point where I'd be up at night about losing that upside. And if sometimes you do, sometimes it blows through there. But most of the time, and this is where our thoughts of delta and probability more important than delta. Probability really matters. Does this make sense?
Yeah.
By the way, pretty easy to graph, right? When you kind of see it, it's with some practice, anyone could do it. Now, these are two very basic ones. The long stock is just one. You can see we have two lines, a long stock line and the cap line. So we have on the covered call, it's a little more complex. Okay, now we have 4 trades.
Yeah, now here's the iron condor. This was the covered call, right? And this was just the long stock. And so here's our iron condor, and you'll learn to do these. And like I said, I can kind of do it in my head. The total credit brought in is max reward. So that's an important number. Max risk, we already calculated, is 360. So that's the most we can lose. And that's going to be important here because if this is plus 140, that's going to become an important number, and this will be minus 360 on our profit and loss scale. Now, if we put our prices in down here, we need this scale to go all the way and make sure that it at least goes from 55 to 75. So let's say that this is 50, this is 55, this is 60, this is 65 per share, 70, 75, 80, and so forth. That's the stock price down here, just as it was here, just as it was here. If we look at this structuring, we want the stock to finish between the short strike prices, between the options sold. That's where max gain will be. So if you go up to 55, oh, whoops, I messed up. We needed more space this way. We need this to start at 45. 45, 50, so even I can screw up, and I've done them a long time, but I looked at the wrong number there. Okay, if we do it like this, I just needed a little bit more scaling to show below this. So if we do it like this, between 55 and 70 is max gain at 140 bucks. So if I find 55 per share and I find 70 per share and I go up at 140 gain, you'll see a flat bar right there. That is max gain, $140 between 55 to 70. Now, max loss is if we get beyond the protective options. The protective options, this reinsurance idea, we reinsured ourselves in case it was below 50 or above 75. So if it's below 50, we end up at a max loss. Or if it's above 75, we end up at a max loss. And these will go flat that way because you can't lose more than $360. No matter how low or how high the stock goes, you can't lose more than that. And then these will connect up to those to create the iron condor risk graph. And lo and behold, there it is. You could even calculate your break evens. You can take that 140, subtract it from the put strike and add it to the short call strike, which would give us a 71.40 and a 53.60 if I did those right in my head. Those are what we call the two break evens. So this break even and that break even would land, this one would be at 71.40 per share, and this one would land at 53.60 would be your two break even spots. And that's where 53.60 should be, that's where 71.40 should be, is at the two break even marks. So pretty cool stuff. Now, again, we don't expect you to follow necessarily every piece of that, but the important point is just seeing how, as these become a real part of what you do, you can understand all these little elements. The question came in, where did the 920 come from? That's the strike price we sold, where we promised to sell the stock, minus our cost basis of 60.80. So if we had to sell there, and that's our cost basis, 70 minus 60.80 equals 920 max reward.
I
Good
just sent
stuff.
that to John. Asked the question. I just sent the math to him. Buy at 61.55, sell at 70, plus we get another 75 cents for the option sold. So that's where that max profit comes from.
Good stuff.
And this is assuming 100 shares, one contract worth.
So look at this.
Who thinks that's pretty cool, by the way, to be able to do that? And I remember Rob Reinhold, the guy who first started teaching me spread trading years ago. I went up and had a mentoring session at his home, and he was doing, and they didn't have software back then to do these. You had to do them by hand. And he's cranking all these out. And I got to tell you, I was intimidated because I thought, I'm never going to get this. I'm never going to get this. Why? I'm a C- student that barely stayed eligible to play college basketball. Okay, I'm dumb as heck. But what's fun is in the ultimate options, every single week you'll do just one. That's it. You'll do one. And well, not every week. About the last 6 months is when we start doing this. So every single week for about the last 6 months of the class, you'll do one. And just in that short amount of time, it'll just click, and you'll actually begin to just see them in your mind's eye. It's really a cool, like when Neo sees the Matrix, it seems complex, but pretty soon it's just. So,
well, think about that. We just spent 10 minutes doing it super fast.
yeah.
Now envision yourself in the Ultimate Options program going through each and every option strategy. So check this out. You think, well, I'll never get it. Look at how many option strategies there are. But think about going through each one of these strategies, piece by piece, defining every spot, drawing these out, doing them on your own. That's literally what you'll do in the Ultimate Options program.
And every single one of those.
Yep.
Every single one of those can be done long.
Every strategy.
It can be done long or short. So the list actually can double.
Yeah, and it does.
Long side or the short side of every single one of those.
Because we teach the long straddle, we teach the short straddle, we teach the long strangle, we teach the short strangle, we teach long stock selling call, a covered stock, right? Covered call. But we also teach a short put along with a short stock. So the covered puts.
And the covered stock we teach out of the money, at the money, and in the money, all three, because you have different purposes. Like you can buy a stock and then you can trigger an in the money that pays you the intrinsic value instead of having a stop loss on it. I mean, there's so many different things you can do. A lot of people buy a stock, put in a stop, and if it goes up, they get the reward. If it goes down, they get out the stop. You buy a stock and trigger an in the money covered call, you can actually, if your technical analysis is pretty good, you can actually not lose any, because as it goes down, you'd sell it at that price anyway, but you got paid the intrinsic value before you did. Anyway, that's getting too complex. Back to the Iron Condor. So
if you look at
this is, by the way, let's go to the chart. Like, can you bring up an S&P chart?
Yeah.
Real quick.
You want SPX or SPY? Does it matter?
Just a chart, okay? So what we've seen here in the last few days is exactly what Corey had said. Is it said, hey, our outlook for this month is kind of neutral to moderately bullish. We haven't seen a massive gain. We had a nice uptick today, but really since our class started, we really haven't seen any huge up or downs. And so it's been very conducive to what we're doing. Now, that doesn't mean we had a crystal ball and that we're right every time. That just simply means the data of what we see would be, suggest sideways to very moderately bullish moves. So we're trading inside this big picture, and we're really saying, look, we don't think there's a big capital gain opportunity perhaps right now. let's use time decay. So let's go back to your condor.
And one comment about just before we leave this chart, Andy, is a neutral outlook. This is one way to think about it. Remember, this is your probability of expiring cone. A neutral outlook, like we've had a pretty good outlook because it really has gone sideways. But when you say you're neutral on the market, of course, you're not thinking that it's going to do this because there's always some volatility, right? What you're saying is essentially that I think it's going to stay inside of these bands and just have a more muted reaction here for the next couple of weeks. Like we've been doing this, we're on a couple of weeks in. Our outlook has been right because it's been
Right.
inside of the bands that were at that time, right? It's just definitely inside of the probability range. It's gone nowhere. And that's what a neutral outlook. If we came out and said, we're very, very bullish, then what we're really suggesting is the market's this bullish a couple of weeks from now, and we're this bullish. We're wildly bullish, right? Or we could come out and say, oh, we're moderately bullish. That means we think it'll kind of move this way.
It'll be in the upper half of that cone is really what
Yeah, exactly. So you can kind of think of it, again, remember that first class we did, we talked about the 5 directions. This is a neutral. This is a normal bullish. This is a normal bearish. This is a very bullish, and this is a very bearish. And they all fit in context of here's your one standard deviation where you should be 68% of the time, right? And here is the abnormal low probability, but does sometimes happen. So you can have any of those 5 outlooks. A normal bearish move would move towards the lower end of the expected range, but not crazy fashion. This would be an extreme bearish outlook. This would be more neutral. This would be more normal bullish. This would be more of an extreme bullish outlook. So good stuff. All right. Oxy. So here's that chart for you, Andy. Oh, did I lose you, Andy?
No, I hit my mute button. I'm
Okay.
right here.
So here is, if we look at this risk graph of the iron condor, here is basically that exact risk graph that we just drew up in terms of the risk and reward, but it's times 5. We did 5 as the example trade. Yep. So notice, go ahead.
Just to kind of cap what I talked about, we can see how at expiration, the price matters. Like if this goes to $76, we'd be in trouble. If this falls to $49, we'd be in trouble. And we can sort of see in this purple area where it would change, very, very much day to day, what the profit or loss we might take before that time period. I will say that at the end of the day, the only one that matters is the delta, because at the end of the expiration day, it's only the blue line that matters. The purple line only matters in the interim. Well, if you look down on the lower right hand in this particular software, and then we'll get into IB, but if you look down there where it says BP effect, there's a cog wheel. So right there, and you pop that open, and we can mess around with some stuff here. We can do a volatility adjustment in the first one. So if the volatility were to fall, right, you can see that, as he just clicks that or holds it down, you see that's going to change our profitability. If he puts in like a -10, watch what happens. Doink. Oh, we're making more money. So before expiration, if we want to exit this trade in a market, boom. Now here's what's dangerous. Let's say that the volatility increased. This is where people don't get it, is they'll do this trade at 0. Let's hit 0 where it is today. Click. Okay, that's where it is today. And then all of a sudden, someone wakes up in the morning. He says, "All right, I'm up $55." And then tomorrow we have an increase in volatility where the options are more expensive. Now we went from up $70 to down 130. People are like, well, the stock price didn't move. Well, what moved was the volatility of the market, the volatility of the stock. Something happened where they implied more problems than not. Now, as long as it stays, this is nothing to fear, as long as it stays within the range, because eventually time decay will take it over. We can actually go right above that field where it says date 2/13/2023, and we can march forward the date, and we can see the time decay. And so we can play with the volatility, which is vega. We can play with the date, which is theta, and we can play with the numbers, this price, which is delta. So all three of those balls can be in the air, and we can kind of get a sense. But I see so many people that are new, Corey, will buy options and try to spread trade without understanding these. And all of a sudden, a spread will widen or volatility will change, and they can't figure out why they aren't making money and why they're losing it. They're like, well, the price didn't move that much. Why did my option go down by half or whatever? Well, they had a change in volatility or what have you. So
Yep.
anyway,
And we see that a lot.
Day and zero. Yeah.
And we
So-
see that a lot in terms of, like, if you come back to zero and you look at this, you kind of think of this like insurance. Here's where we're at today, and here's what the insurance is priced at. But there's all sorts of news that could circulate about this stock or about the market that could change how the options are priced, right? And that would be volatility changes. The expectation is for X amount of volatility right now, but that is subject to change. Either the market could say, you know what, there's going to be lower volatility than we thought, or the market could say there's going to be a lot more volatility. And it's sort of like, if you think about like hurricanes and natural disasters, this is like an insurance market. Right now it's priced at zero. Tomorrow a hurricane forms and it looks like it's coming to Florida. Well, all of a sudden that changes the volatility. If I just went out and bought some option to insure myself the day before, I'm a happy camper because now I'm protected. But this basically tells you this is the opposite. This is kind of, we're betting on calm, and now something crazy seems more likely. Well, I can close the trade immediately, but I'm going to take a loss because now the stock expectation has changed. The amount of volatility, if I want to get out of this, it's like I'm the insurance company and I sold someone a premium for flood insurance or whatever, and the next day a hurricane starts to come. I could go and try and buy back that thing, but I'm going to have to take a loss. I'm going to have to pay them some money to go away from that contract, right? In this case, if volatility were to shift up, that means the market is saying, hey, this stock is going to be more crazy than expected. Well, that hurts our trade. That hurts our trade, so we can close it out early, but we take a loss. Now, as Andy said, time could overwhelm that. If it just so happens that time ticks away and the market got it wrong and it wasn't as volatile or whatever, we could still overcome it. But just know that there can be those changes like he was talking about. So that's an important point. And that's what that purple line, to your question there, who asked that? Somebody was asking about the purple line, and now we're showing it. Oh, Simone. So the purple line is the progression. The blue-ish line is at expiration. So you'll notice this risk graph doesn't change. It's where you'd finish at if it was at this price at expiration, or where you'd be if it was at this price or this price. So this is the at expiration. The purple line conforms and eventually becomes the blue line, but it's the progression line. It's how the progress of this trade goes as we move to expiration, and it becomes those results. So anything between now and then, it's time decay, it's volatility changes, and so on. It's kind of showing that change in process. So kind of a fun graph there. But here you can see the total numbers. You can see that we collected 63 cents credit on that side. We collected the difference between 127, which is what we brought in, and 50 cents on that side, which is $0.77, which equals $1.40 total. So we brought in $140 per iron condor, and we did 5 of them. What's 140 times 5? Well, that will be our max reward. So if I put my cursor up here, notice the $700 profit you'll see. That's $140 times 5. Our max risk is 360 times 5. That's $1,800. So if it's way down here or way up here, that's where our max loss would occur. So you can kind of see that process. Now, we promised to show just a little bit on Interactive Brokers. So can we do the same things? That is the question. Yes, we can. Like we said, don't get caught up too much worried about who your broker is. You're going to get familiar with their platform. It's going to make more sense, but it's more about you understanding the numbers, right? The mechanics. What are we trying to get out of this trade? What's the process? But let me show you. This is Interactive Brokers, okay? Can we do the same stuff? Yes. We can do it in a few different ways. I could type in Oxy stock symbol, and I could literally click here and select every one of those options. Watch this. I could select the 50 put and the 55 put. I could select the 70 call and the 75 call.
Just a different way to get to the same place. If you look at your risk graph, it's going to have that same list.
It's going to have those 4 strikes. Look at them. There's the 4.
Same strikes, same everything.
Okay,
same.
so they're the March 17th and all the same strike prices that we're trading of the puts and of the calls.
That's actually faster. That brokerage is faster to get to there than TD Ameritrade. I mean, well,
yeah, all I had to do was point and click, and now watch. If I right click, well, all of them are highlighted. Let me show you how to highlight. It's like an Excel program. If I click on the top, hold down the shift key and click on the bottom, they're all highlighted, right? Or I could have held down the control key and clicked on each one. But if I click on the top, hold down shift and click on the bottom, they're all highlighted. I right click, build a complex order. Whoops, it pulled it up on my other screen. Look at this. Now I would simply say I want to sell that one and sell that one, and it's built the trade. I just right clicked when they were all highlighted and clicked build a complex order, and then it pulled it up. And I just need to make sure that I'm buying and selling the correct options. That's one way to do it. And then from here, you'll notice I can click the profile, and if I hit that little profile button, right, it pulls up a profile right here. And of course, the numbers are a little different because the trade's already making money. So we can put it on today, but we won't get as much credit as we did putting it on over time, right? When we put it on, we got $1.40. It says, well, you could put on the same trade today for about $1.22 credit, which would leave you about this max reward and this max risk, okay? And it has, check this out. We're at February 13th, and this is saying, here's where you'd be if it moved up 1%, 3%, 5%. But I can't see the whole risk graph yet. I need to give it more space. If I give it more space and say, let me see what 30% movement in the stock will do. Do you notice this risk graph? Does this look familiar to anyone?
Thing. And don't freak out because someone's going to say, what's the gamma? You talked about delta and big and theta. Gamma is the rate of change of delta. So where delta is to velocity is gamma is to acceleration if you're a physicist. But we don't worry about that just yet. We cover all this stuff in advanced classes. But you can tell that they're advanced classes. But you can see it's the same data. It's the same stuff. It's just which cockpit do you want to sit in? What's the same?
And see how there's a progression bar, and then there's the at expiration risk graph. You see that? And look at where the risk graph is. You see how it's drawn identical. See where our max loss is at 50. Let me change it to yellow so it'll show up nice on that black. See how the max loss on this side is at 50 per share, and at this side at 75, just the same. See, our profit is if we finish between 55 to that 70 level. It's not exactly 55 and 70 because of the break evens, but anyway, same numbers. And then we can take it one step further and we could change the date and look at the progression of this thing. And we could move it forward over time and see how we're more profitable as time ticks away if we're inside that zone. And eventually we get to May 17th, where we would be at maximum gain or maximum loss depending on where we finished. And so now the progression has conformed to that identical. You see that? So it's
bigger point, I think, that I'd like to ask, does everybody, kind of understand? I thought it was a great question last week, and that's what Quick Start Labs are for, is first of all, I think the person asked the question said, hey, I don't have risk graphs in Interactive Brokers, and maybe you just hadn't found where they were yet. But can everyone see it's kind of the same stuff? Well, it's not kind of, it is. It's the same. A strike price is a strike price. A bid ask is a bid ask. An expiration is an expiration. The risk is not going to change. It's like, basically, do we know what we're doing? And you can learn how to build it in one just as easily you can learn how to build it in the other. It's just really a preference for the graphic user interface. Do you want a solid line and a dotted line, or do you want a blue line and a purple line? It just depends on what you want. Is this helpful to kind of see? Does that give you guys some comfort to realize, okay, whatever brokerage I want to use, I'm going to use. Most of them have. It's a lot like a car. Most of them have an audio system and a windshield wiper system and a turn signal system and a park brake system. These knobs just might be in different places,
Yeah, and this could be.
I put my truck in my older truck. I got an old Ford that I will never sell. I love it because I fit in it. But my truck, I go to 4-wheel drive with a shift on the floorboard. In Marcy's FUV, she has shift on the fly with a button, but it does the same thing, right?
Yeah, 100%. And this can be helpful for those that are kind of navigating Interactive Brokers that might be international traders. Maybe they don't have, if you live outside of the US, well, you have access to this platform. You might not have access to another. Again, it really probably doesn't matter because everything that you see here, you should be able to, over time, do it manually to where it really, really makes sense. But in the meantime, you can build the same stuff. You can build the exact same stuff. And I guess, speed wise, they were pretty darn close. I don't know if we were timing it, it's going to be pretty darn quick either way building these trades once you figure it out. So the process is very similar as well.
Fantastic, Corey. Fantastic. All right, what do you think for a lesson here? So we've introduced Greeks a little bit. We've talked about some of the things a person should learn if they want to do these more advanced trades and have more premium. We've had a chance to check in. I think we're up a little bit. And as the time decay goes on, we may or may not have to delta hedge this or exit or use one of these. Hopefully we do. We made it pretty narrow in the hopes that we would, but so far it's behaving itself. But we do, if you adjusted the price slices to break evens, it's pretty narrow. I mean, we're at a 67% chance of having this happen, but there's a 23% chance to the upside. So it's about a 1 in 4 chance we should have some headache. But that's, if we went to probability of touching, right now our probability mode is in the money, but you can actually do it. What's the probability of it touching? And that's right above. You can see where that is. That's right. If you go up, it's not in that list.
Oh.
But if you go up, right, see where the 80% probability is? Oh, right there. Oh, over, right,
yeah,
right.
Where'd they go? Right here?
Left, one more section left where it says,
there it is, yep.
The touching, the probability it would touch that strike is pretty high. I'd say it's 50% or better. If we drag that price slice over to the strike of 70, I'll bet so we got about a 60% chance of having some headache in this thing. So better than average chance we're going to have to do something with this, because the probability of it touching and then retreating or extending is higher than the probability of landing.
Yep.
Which is another discussion for another day. But anyway, we can go back.
And yeah, and if you kind of look at this in terms of out of the money or in the money, as Andy really pointed out, you can see that our danger zone, and hopefully everyone kind of can see this instinctively, but if we put this right here on our short strike at the 55, and we put this right here at our short strike of 70, this is where we want the stock to be between. Notice the difference in probability out here.
Ouch.
This
Yeah.
one, much higher probability that we have a problem here than out here. 13% chance we go below this one. Well, that seems good, and we're outside of that shaded, that 68%. That's what the shaded represents, is that standard deviation, right? But over here, heck, there's a 27% chance that we're going to be above that strike price. So we still have, you know, some potential risk, and that's really due to the fact that the stock's up here right now, and then we're not far away. We're only 5 points away from hitting that level. We're 10 points away from hitting this one. So naturally, we're much more on guard. We're watching more closely this side of it. And you could kind of say that the way we're positioned, we are positioned neutrally, but it would give us a little bit of relief if the stock was to go down a little bit in the short term. It would relieve a little bit of the potential for us needing to hedge and do some things with this trade. And we did this on purpose to make sure that we would have some stuff to really play around with here.
We'll talk about
the trade goes.
We'll talk about next week some of the emotions that go on with this, because where new traders get killed is they watch one quick start lab, then they go out and try to do it in a real account without Greeks, without exit strategy, without this. And you can see already that if tomorrow it gapped up $5, we'd be down about 450 if we want to just leave the trade. And you don't want to lose 450 bucks. You want to make, like, what's our max on this? 630 or
yeah, 700 bucks.
We want to make 700 bucks. We don't want to lose whatever it would be if it gapped up. So important. Yep. Okay, you want to talk about puts?
Protective puts? Yeah. So if we come back to this, we wouldn't need protective puts so much on this or on this right now, but you could explore the idea. Remember, we talked a little bit about married puts at the very start, right? You buy the stock and you marry it with buying a put. Well, you can get married at any time, right? You don't have to do it at the moment you buy the stock, right? You don't have to do it at the moment you graduate college, so to speak. You can get married 5-10 years later. Well, same thing with the stock. We can buy the stock today. We can marry it with a protective put anytime we want down the road. And that simply means that if we buy a put here, it now gets linked to the stock we own. So if we bought 100 shares, when we first started looking at Oxy as a trade, our very first class, we said Oxy looks bullish. Remember, it was down on the trend line that it had hit a number of times, and we said, we're bullish. We think it's going that way. We could buy the stock at 61.55 and we could generate dividends, or we could buy the stock, generate dividends, and do covered calls. If we had bought the stock at 61.55, let's explore what buying a protective put would do for us. Let's marry a put with that. So watch this. If we buy the stock, 100 shares, but we had bought it back when it was 61.55, okay, let's go analyze this trade and let's nuke this stuff. We don't want that on there. Here's our risk graph for having bought the stock. Do you see we bought it at 61.55? If the stock goes up, we make money. If the stock goes down, we lose money, right? Pretty straightforward if we had bought stock at that point in time. Next, it's a couple weeks later from our first class. but we think, well, maybe we need protection. I'm not sure that's the case, but we're just doing educational examples, right? So here's the stock at 64.94. And if we were to buy a protective put, what we're basically saying is we want to insure in case it goes that way. We want to have a hedge, because if our stock is losing money, our put can be gaining money, and they'll somewhat offset each other. So why would you, first of all, let's ask why. Why would you buy a protective put? Because you're worried about a big downside move. That's the reason why you would do it. You want to have a hedge trade, a protected trade, in case we fall sharply lower. Next, we would need to think about, okay, well, let's assume we want that protection and we're nervous about some downside. When do we want to buy protection? How much time do we want? Do we want short term that expires quickly? Do we want intermediate term? Do we want long term? Generally, when we buy protection, we'd be more in the intermediate term. I would say would be more commonplace. We're probably not buying 4-day protection, and we're probably not buying 858-day protection. But we say, okay, we think the next couple of months could get bumpy. Let's go out and buy some put protection. So this trade that we're looking at, this option scenario, is a May expiration. Let's make sure everyone follows. May 19th is the expiration date, which is 95 days away. The stock is currently worth 65. We can go decide where we want to be protected from. We could say, well, we want protection immediately, which is called at the money. Or we could say, well, we really feel like we need to be protected, below 60, or this is called out of the money currently. We could even buy protection that's, quite a long ways out of the money. The further you go out of the money, the less protected you are, but the less the insurance costs as well. You want more protection, it costs a little more money. You want a lot of protection, it costs a lot of money. So I'm going to go with this one. I'm going to say we'll go a little ways out of the money. It'll cost a little less, but it'll protect a little more than way out of the money. And let's analyze this together. Let's say that we spend this amount to buy this put. So now we need to click on it. We say, okay, let's buy one of those. If we buy one put, one contract, it controls 100 shares of stock. And it costs about, at the midpoint, looks like it's about 330 to 335 at around the midpoint, but let's just leave it. Well, let me think. That's fine. Let's leave it at 335. We'll right click and analyze. Now look, ignore the other stuff and just focus on the two selected positions. And this has become your new risk graph. Now this risk graph is pretty interesting here. If you look at this risk graph, what you have just done to your stock position, watch. If I unselect the put, watch what happens to our risk. See how it's flattened out right now? Watch. If we don't have the put protection, our potential risk, this is thousands of dollars of losses.
Yep.
Thousands. Watch what happens when you have the protection. Whoop, flat, $500 basically at risk.
Give a context shift for this.
Yes.
And I'll ask these questions as I often do. How many of you have insurance on your home? Maybe you've got a home that's a couple $1 million, $1 million, 500,000, whatever your home is worth. Do you have insurance on your home in case it burns down? Okay, what's more likely to burn down in the next 12 months? Your home or your 401k? This is life-saving, financially life-saving information. And what was interesting is when COVID hit, I bought Exxon on the way down at 55. And then a couple days later, I bought a bunch of insurance in case, because I didn't know what was going to happen. But I definitely wanted a floor on this because, you know, who knew what was going to happen in COVID. So I knew I wanted to buy it right there, but I also, and you know, it turned into several $1,000s of intrinsic value having insurance. And what was crazy is I cashed out that put at a time I really liked, which lowered my cost basis even further. So just the idea of having a flat line right there for some people, you know, might be worth it. I don't always spend money on insurance. I tend to pick and choose when I do this, depending on the environment, the amount of money I have in one place. But it's an incredible deal here, right? It's incredible.
It is, and this would be a very good example of kind of a way to do it, because a couple of things here. Number one, we bought the stock at a better price point. And if we had bought the insurance, if we had married it by buying insurance at that time, the insurance would have cost more money.
Yeah.
But by waiting for the stock to advance, we happened to get this one right, and the stock did advance as expected. The insurance went down in cost because
and not to interrupt, Corey, but you can marry this with technical analysis and moving averages to say, look, like I'll give you an example. Corey and I are both cancer survivors, so and we're both, you know, self-employed people. So we buy our own insurance. Well, I do. I don't know if Corey does, but that's how
I do.
And so I tend to have massive deductibles because I don't want to pay a lot of premium. I'd rather just pay out of pocket if I have the sniffles, go to the doctor, than to do this. What I'm really worried about is catastrophe, right? I am worried about catastrophe. So I can look at 200-day moving averages. I can look at supports and say, look, I wouldn't care if I lose X or Y, but there is a point where I'd say, boy, this is starting to deteriorate my net worth and the actual machinery which is building my stuff. Maybe I want a little protection, sleep better at night. So the further away from the money you go, then you're more, then the insurance becomes less and less in terms of premiums. You have a huge deductible, but you're protected against the catastrophic black swan event. And that's usually when I want to start buying more stocks anyway. So
yeah. And that's a great point. It's kind of like a car insurance analogy where we could buy insurance that's fender bender insurance, right? It protects us against the minimal damage. Or we could say, you know what, I'll pay for any minor damage, but I really want to be protected if this car gets totaled. I don't want to have the full bill. And so that's kind of an approach.
Or you can bundle and just buy some S&P insurance. Look at what your beta weighting is. It's all right. Based on my stuff, you know, I beta weight it, meaning I see how my portfolio moves relative to the S&P, and I can buy some. We do that in Mentor Club a lot. So
yeah. And this one, you can see it has that catastrophic insurance covered, because you throw out any number down here and it doesn't matter. Our line is fixed. We have a limited risk because we're insured, and that's what insurance does, right? It limited our risk that way, but it didn't cap our upside. Our upside is uncapped, and we paid a premium for that insurance. So, you know, that costs money. This insurance doesn't come free, but it costs some money that limits the damage.
Next week, we might review, there's an 8th trade in the 4 pillars that we do cover called the collar. We do cover that. It's a covered call with a married put. It's all 3. It's the stock, the short call, and the long put. And maybe we throw that on there too to show a neutralization. Just pour antacid on the problem and stay tight when the storm hits. We could do that too. So.
Yeah, and if you're in ultimate options, you could get really crazy with this, and you could say, well, I'm going to buy protection that goes out 90 days, and I'm going to sell some short-term covered calls. So you're creating a collar, but you're creating more income on that side. And there's so much fun stuff, but ultimate options is killer for that reason.
Here's the bigger question. This is the most important question. How many of you are starting to catch a vision that there's a lot of cool stuff out there the average person could be doing that they're not? There's a lot of financial education they could be getting, but they're not. And that's the biggest question I would pose. So to make sure people say, okay, there is hope, there are possibilities. I don't need to be in the rat race forever. There are things I can do, things I can learn, things I can practice, things I can perfect at my own pace, at my own speed, to the urgency I feel I want to learn them. So we always,
Ultimate Options is a lifetime class. So you buy it once, but you'll be going through those ultimate option classes. Like we have people that have gone through it multiple times over multiple years. And
right.
it's a beautiful thing when you can just go to your ultimate options course, pull up the protective put classes
Review
and
it.
watch those and review them anytime for the rest of your life. So, I mean, it's pretty incredible stuff.
We'll give every year, we give a special on Ultimate Options during the Quick Start Lab. I'm not going to do it today. We've got plenty of work to do before we get to that point. But just be prepared. We'll make a nice sale on that. And for people that say, okay, I think I'm ready. Not everyone will be, but for those that are, that'll be great. I'm also going to give people who didn't have an opportunity a link for our Houston event. How many of you are registered for the Houston event already? It's the first one we've ever done live. We had a meeting on this and it's just getting better and better. The 3 days we have prepared to you, I'm excited to go and learn from Noah and Corey the topics they're going to cover. But it should be a great 3 days. So a lot of you guys are registered, fantastic. Who is not yet registered for that event? Who would like to go? Let me find I'll find it here somewhere. Hang on, give me a minute. Link. Cal, I had it and now I've lost it.
Oh, you're finding that. Omar says, you're telling me we can sell covered call income to offset the cost of put insurance. That's exactly what we're saying.
That's called a caller. That's exactly
and literally right. You can eliminate all your risk and maybe, we don't know if you'll do it for sure, but maybe that insurance will cost you nothing because you'll bring in income on the other side selling call over here that generates as much income as the protection cost. So if the stock goes this way, not only are you insured against your losses and not losing during that drop, but you're basically paying for the insurance for free. I mean, it's incredible. It's pretty awesome.
I don't know if it worked. I tried to send out the link in the question box. I have no idea whether it worked or not because I don't understand how I know how to send stuff to individual people for sure, but I don't know how to send it to a group. But
it looks like we had a couple of people type in the link. So okay. I'm gonna send it to all. Everyone should see this from me. TCFA InvestorSummit.com. Very cool.
TCFA stands for the Cash Flow Academy. So TCFA InvestorSummit.com. Get your flights, get registered. It's gonna be something that is just, I can't wait for it. And it's our first one we've ever done, so there's a lot of pressure to make it awesome. And
it's gonna be as a live event and just 2 full days of just
bring
in
all your hurdles. Next week we had some questions about price slicing. What else did we have a question on? We had I said good topic for next week. We had a question on alert systems. So we'll answer those very quickly and briefly and get the job done next session. So price slicing and alerting, 2 very important skills to have as we do this. And then we'll see, hopefully, we've got a while before our next one. When's our next one? Because Corey's going out of town.
Yeah, it's a week from today.
We may have to adjust that thing before, but you know what? Maybe we just let it go, Corey. It is in a paper count. If it sucks, then we talk about the repair and awful and what we can, I don't know. We'll figure it out day to day. Because a lot could happen in a week. We could be in a lot of trouble in this trade in a week. We really could. So keep an eye on it. Use your judgment. We might talk about what Corey did, or we might just let it go south. Take plenty of screen captures. If you decide to manage it because you hate losing it psychologically, then go ahead and take lots of screen captures for us. See what you did. But most of all, just love to everyone. It's a lot of fun. It's incredible Dean says, let's do another one in Europe sometime. That would be cool.
That would be fun.
And now we have TCFA set to YMCA in the head, Kai. You just damaged all of us psychologically for the day, Kai. Kai's got TCFA set to YMCA by the Village People. Now that's going to be in my head the rest of the day, Kai. Thanks for sharing.
Well, now that's a brilliant idea. You gotta come and learn from the TCFA.
Yeah, it's just
You gotta
frightening.
learn from that.
We might have to do some with that. Of course, I have no musical ability, but there you go. So,
Well, you just heard the best I can sing, so
better
you know I have no ability.
no, Jackie can sing too. She's artsy and talented. So there we go. All right, guys, enjoy.
Jorge says, just please no leather chaps. So
Oh my goodness, are you kidding? Yeah, can you imagine the Village People in this day and age? Oh my heart, scare the heck out of me. So, all righty, we'll see you guys next time, and thanks for coming. We'll see you soon.
bye, everyone.